During March of 2020, when it looked like that was it for the stock market, I learned a bunch of things that really helped me stick through that entire period and a year later come out on top. I came up with four principles that really helped me stay disciplined and help me throughout this investing journey. And I hope they help you out as well. So before I began investing, I made sure I did a lot of research as far as the industries I wanted to follow, the types of stocks I wanted to buy, the types of ETFs I was comfortable with, and what my sort of goal was. Did I want to become a dividend investor or a growth investor or sort of a happy medium between the two? And with all of that research, I also made sure I was comfortable with the idea of very low lows and super high highs as far as the market goes. Number one, so the first and most important thing you want to do before starting any sort of investing is building an emergency fund. So for me, that was about 3 to 6 months worth of my general expenses, and I wanted to make sure that I had this money readily and easily accessible. So I had this money put away in a high interest savings account. And yes, it's not really doing much, but in the event that you need that quick cash, it'll be readily available to you. And with high interest savings accounts, I prefer to have it in there rather than a checking account because at least it's incurring some kind of interest there, whether it's 0.75% or up to 2%, still better than nothing. But the most important part is that you have this money ready to be withdrawn in the event that you need it. Number two, when it looks like the sky is falling and the market's crashing, you want to make sure that you look at it in a more positive light. So during the big sort of sell-off of March 2020, I looked at it as a big sale that was taking place in the marketplace. When my parents were telling me to sell everything and try to recoup as much as I could, I looked at it more in the sort of light of being able to buy whatever I wanted at record low prices. And because I did that, a year later, I'm already thanking myself. I practiced what's called dollar cost averaging. So basically what that means is over an extended period of time, you put in the exact same dollar figure and average out your cost over time. So for example, this week I decide to put up $20 into a particular ETF. Next week, I'll put another $20 into that ETF and continue to do so for as long as I want to. This way, my average cost of that portfolio or that stock is only increasing every time over the sort of same amount of money. By doing this, I'm able to consistently maintain a buy-in and my average cost is only increasing at a slower rate than say doing a bunch of like mass buy-ins once or twice a year. And the second thing to keep in mind, especially when it looks like everything is on sale, is as tempting as it may seem to go and buy a bunch of tech stocks or a bunch of Tesla stocks or whatever have you, you want to make sure that you come up with a split as far as your portfolio goes with what you're comfortable with. So what I essentially did when I was about to buy in all of these stocks was dividing up my entire portfolio on a percentage basis. So I knew I wanted to put a certain amount of money into the banking sector, into, let's say, the tech sector with home and consumer goods, and so on and so forth. Because I did that before buying anything, I knew that once I hit a certain threshold or a certain dollar figure, I didn't want to exceed it. Otherwise, my portfolio would not be balanced. Number three, don't panic sell. As tempting as it was last year when I saw my portfolio in digits that I didn't even want to see negatively, it was pretty tempting to sell everything, recoup my losses, and just move on with the next best thing and go buy something else like gold or silver or something like that. But it took a lot of serious discipline and a lot of really talking myself out of it to keep my stocks and to continue buying. It was really tempting to want to sell, but I'm really happy that I held on to it because as tempting as it was, everyone was doing the same thing and they were selling off like crazy, which is what caused the stock prices to dip. But as long as you look at it as a positive opportunity with a longer term goal in mind, it's a lot easier to hold down these securities and experience the better outcomes in the longer term. And number four, I think this one personally is the most important one, and it's educating yourself. You need to be willing to look into the companies that you're investing in, what's happening in the market in general, and just staying informed. There are many things that could affect the way your portfolio performs over the span of a day or even several weeks. But as long as you're informed and you're well aware of what's happening, you can prepare your portfolio to work the best way you want it to. There are several books that you can read out there. Check out the links below to find out one of the books that I really love reading every so often when I want to learn more. But that being said, it's in your best interest to stay ahead of the curve and continuously learn for the betterment of your portfolio. So the next time that you see a bunch of these articles saying the market's crashing or there's a big correction up ahead, I hope that you can see it in a more positive light and that these 4 tips and tricks will help you better. Keep in mind that you want to make sure you have an emergency fund. You want to look at these events in a more positive light. Don't panic sell if you can afford to, and always continue to educate yourself. That's it for today's video. I hope you guys enjoyed it, and if you do, please hit a huge thumbs up. Don't forget to subscribe to the channel for more content, and let me know what you think in the comments below. But until then, I'll see you guys next time.